Welcome back to Djji Tutorials. Today we are discussing the difference between hedge funds and mutual funds. These are key points that you need to bear in mind when thinking about your finance. Hedge funds and mutual funds are both investment vehicles that pool money from multiple investors, but they differ significantly in their risk profiles, investment strategies, and accessibility. Hedge funds use more aggressive and riskier strategies, are only available to accredited investors, and charge higher fees than mutual funds. Mutual funds are more readily available to the general public, offer a more diversified portfolio, and typically use more conservative investment strategies. Here's a more detailed breakdown. Hedge funds. Risk. Hedge funds are known for taking higher risks with their investment strategies to potentially achieve higher returns. Investment strategies. They employ a variety of strategies including short selling, derivatives, leverage, and investments in non-traditional assets like currencies, real estate, or emerging themes. Accessibility. Hedge funds are generally only available to accredited investors, meaning they have a high net worth or meet specific income requirements. Fees. They typically charge higher fees than mutual funds, often including a management fee, usually 2%, and a performance fee, typically 20% of profits. Transparency. Hedge funds are less regulated than mutual funds, leading to less transparency for investors. Lockup periods. Many hedge funds have lockup periods, meaning investors may not be able to withdraw their funds for a certain period, such as 1 year. Mutual funds. Risk. Mutual funds generally take a more conservative approach to investing, aiming for steady growth and minimizing risk. Investment strategies. They primarily invest in traditional assets like stocks and bonds, with the goal of providing long-term returns and diversification. Accessibility. Mutual funds are publicly available and can be purchased by any investor with a valid investment account. Fees. Mutual funds typically have lower fees than hedge funds, with expense ratios ranging from 0.5% to 1.5%. Transparency. Mutual funds are heavily regulated, requiring them to provide regular disclosures about their holdings, strategies, and performance. Liquidity. Investors can usually sell their mutual fund shares at any time, unlike hedge funds that may have lockup periods. In essence, hedge funds are for investors who can handle higher risks and are seeking potentially higher returns, while mutual funds are a more suitable option for those seeking a diversified and less risky investment. Hedge funds are for sophisticated high net worth individuals, while mutual funds are open to a broader range of investors. Here is an overview of global hedge funds. Global hedge funds are firms that manage large pools of investor capital using sophisticated strategies to generate returns, often exceeding traditional investment benchmarks. They employ a range of investment techniques, including short selling, leverage, and trading in non-traditional assets, making them distinct from other investment vehicles like mutual funds. Examples of global hedge funds include Bridgewater Associates, Renaissance Technologies, and Citadel LLC, each with their own unique strategies and investment approaches. Here's a more detailed look at some notable global hedge funds. Bridgewater Associates is renowned for its macro investing approach, making bets on major global economic trends. They notably predicted the 2008 financial crisis and shorted the stock market before the crash. As one of the largest global hedge funds, they manage a significant amount of assets. Renaissance Technologies employs a quantitative approach, using complex algorithms and mathematical models to drive investment decisions. They are famous for their data-driven strategy. As a well-respected global hedge fund, they manage a substantial amount of assets. Citadel LLC is a multi-strategy fund, investing in a variety of asset classes including equities, commodities, and fixed income assets. They are one of the largest hedge funds globally, managing a large sum of assets, which places them among the top global hedge funds. Other notable examples: Man Group Limited, a UK-based hedge fund, known for its global macro strategies. AQR Capital Management, Another major global hedge fund employing a quantitative research investment strategy, Djji Company, a global hedge fund known for its global macro and long-short equity strategies. Millennium Management, a large global hedge fund with a diverse portfolio of investment strategies. Elliott Investment Management, a hedge fund known for its activist investing and distressed debt strategies. These examples showcase the diverse range of global hedge funds, each employing unique investment strategies to generate returns for their investors. Let's talk about international mutual funds. In 2023, top-performing Canadian mutual funds included Purpose Ether ETF CLF, CI Global Alpha Innovators Corp CLF, BMO ARC Innovation Fund F, and TD Science and Technology F, according to Morningstar. Other funds like AGF Global Select Series F, Blue Bay Emerging Markets, Corporate Bond Fund, and CI Canadian Dividend Fund Series F also showed strong performance. Top-performing Canadian mutual funds in 2023 according to Morningstar. Purpose Ether ETF CLF. This fund focused on the alternative cryptocurrency space, achieving a significant 77.93% return in 2023. CI Global Alpha Innovators Corp CLF. This fund, categorized as a Canada fund sector equity, delivered a 58.05% return in 2023. BMO ARC Innovation Fund F. This global equity fund recorded a 56.92% return in 2023. TD Science and Technology F. This Canada fund sector equity fund also performed well, with a 53.92% return in 2023. Other notable Canadian mutual funds. AGF Global Select Series F. This fund, part of the broader global equity sector, consistently delivers strong returns. Blue Bay Emerging Markets Corporate Bond Fund. This fund provides exposure to emerging markets, potentially offering diversification. CI Canadian Dividend Fund Series F. This fund focuses on Canadian dividend-paying stocks, offering income generation alongside capital appreciation. Important considerations. Past performance is not indicative of future results. Investment markets can fluctuate, and past performance does not guarantee future success. Consider your investment goals and risk tolerance. Different mutual funds have different investment strategies and risk profiles. Diversify your portfolio. Don't put all your eggs in one basket. A diversified portfolio can help mitigate risk. Consult with a financial advisor. They can help you assess your individual needs and recommend suitable mutual funds. As students, you may think this information is not necessary for you to know, but you don't need to wait until you have a family before you can start investing. We hope you find this video useful. Please like, share, and subscribe.